credit insurance, and there are numerous. And I would argue that if many or all of these benefits are used without a claim ever being filed, the credit insurance policy pays for itself. So we spoke about the customer default. So that's obviously protecting against bankruptcy. I spoke a little bit about trying to expand your sales to new existing customers. Basically, companies have to get their sales to keep growing so that they can keep expanding and be profitable. And you want to be profitable, so hence the credit insurance helps you on that aspect. Concentration risk, that's if you're exposed to, or maybe one or few customers have a major exposure on your balance sheet. Remember, we had a customer in the scrap metal industry. They would probably had a $300-400 million exposure to Nucor. Scrap metals, as many of you may know, have low margins or narrow margins. If anything happened like in Enron in that situation, the company would never recover. So in a case like that, the underwriter will cover it, and they'll probably offer a really cost-effective rate because Nucor is a very good company. The facilitating the attractive bank financing, the lifeline or lifeblood of a company. So if you don't have credit insurance, a bank may lend you 60 cents on the dollar. With credit insurance, they may well take it up to 80 or 90 cents on the dollar. So credit insurance is a tool that the banks like to use, one, because they can lend more, but two, then there's a security where they're named as the loss payee. And in the event of any of their customers going bankrupt, the insurance carrier would pay the bank directly. Supplementing credit risk management. This is a big component, especially in Europe, which is why the penetration there may be higher. But basically, a lot of companies want the credit management expertise of an underwriter, where they either become the co-credit manager or they supplement the credit manager protocols. Selling into foreign markets, it's one thing selling within the US, but if you start selling into a new market where there's different languages, laws, how do you recover your assets, who do you go to? There's all sorts of challenges and implications there that a company has to deal with. And using credit insurance policy where the actual underwriter will have expertise, maybe the company has actually a division in that country that can help. The claims adjusters are all very experienced at collecting from these foreign markets. It's a big part of it. Validating protocols, credit protocols, ties in a little with the D&O compliance. If somebody buys a D&O policy, then the CFO has to often sign off that the credit management protocols are correct. In that case, the fact that a third pair of eyes is looking at the policies, looking at your credit division, looking at your credit management practices, has set limits for your buyers, makes it easier for the CFO to sign off on the credit protocols of the company. And then if you're involved in the export arena, there's a geopolitical risk assessment that's needed. So, and we'll get into a little more of how that happens, but basically they would be able to tell you what the risk status is of a country, if there's an economic impact that you should be looking at for, or if there's some other political event that you should be careful about. Cost-effective collection services. The big carriers tend to have their own in-house collection service, and the excess of loss, and I'll get into that as well down the way, they tend to outsource it on a cost-effective basis to a collection service. And then lastly, gives a company and a lender comfort as a second sort of repayment in the event of a claim.